So, Steve, having been in the industry for 25 years and working on mergers and acquisitions in wealth and asset management, what sort of changes have you seen in terms of deal economics and just overall deal structure for wealth management firms over the last 15 years?
In terms of how deal economics have evolved, I would say they have moved materially over the last few years. A few years ago, you might have seen 50% paid for a wealth manager at closing. And depending on the size of the firm, you could be looking at 5 to 8 times EBITDA. I would say even for small firms, namely 500 million assets under management, we're now seeing much higher percentages being paid at closing, sometimes 80, 90%. And that's off of, and these are EBITDA multiples, which are higher, often over 10 times EBITDA, sometimes 10 to 15. And they're multiplied by the adjusted EBITDA, so including cost synergies. Also, payout terms are shorter. Used to be you'd get paid over 3 to 5 years. Now it's often 1 or 2 years.
So I would say first that our pipeline remains really strong going into next year. And what we've heard from discussions with various acquirers out there is they have a lot on their plates as well, with deals closing even over the next couple of quarters. So I think that now through probably the first half of next year, we're going to see a wave of deal announcements. As we sit here today, the market volatility that we've seen over the past year and the rise in interest rates, we've not seen that affect valuations on the aggregate. Perhaps as a result of higher rates, we could see this change over the next 6 or 12 months, depending on where rates end up. What we do see is some buyers being more selective. So picking their spots a bit more. We're receiving fewer offers for clients than we had in the past. But again, at the upper end of the valuation range, and for really solid firms, the market continues to be as strong as it's ever been.
As these acquirers have focused on, the highest quality firms or certain geographic markets that they really want to prioritize, well, what's happened is then, that has sort of supported the multiples and the valuations in the highest quality firms that are coming to market. So I think important note there is that, yes, we are seeing maybe slightly less activity and interest for certain firms than there was a year ago, but recently that has, as they've reprioritized to the highest quality firms out there, it's supported valuations at those levels as well.
I don't see the activity coming to a grinding halt because the industry is still so fragmented. In 2022, there were 1,000 new RIAs created. So, the number continues to go up, which is greater than the number of transactions. And it's just a very fragmented industry. And to Dan, John, and me and our team working with sellers, even the best of them, there's only so much one can do as a small independent firm. These large aggregators who are able to invest many, many millions of dollars in technology, research, AI, marketing, you name it. It's very, very hard for the small firm to truly differentiate and compete. And I think that's going to continue more and more over time. That I don't think we're going to see this consolidation. As Dave also said, there's so much dry powder from the private equity firms to consolidate this space over the next few decades. I don't think it's going to stop. If anything, I just think it's, as we've discussed, probably the buyers get more selective on what they're willing to pay for what.
The markets we focus on, including wealth management, but also insurance, healthcare services, there's sectors that aren't going away. Each time we've kind of gone through a downturn, we've frankly come out with more interest, from, especially on a risk-adjusted basis, more capital drawn towards the sectors we cover than there was going in, and they were healthy going in. I think Dan's exactly right. Listen, in the near term, there's some choppiness, but in the mid long term, this is a great sector. The runway is there. The capital is there seeking opportunities. We may see lift in interest because capital that maybe used to be focused on other sectors that come out of a downturn, those other sectors end up more beat up or less investable than they were going in. That capital still needs to be put to work somewhere, and this is a terrific sector.